ComfortCare is a not-for-profit, home-based palliative care service designed to fill a gap in the palliative care sector. Palliative care helps people nearing the end of their life to live as well as possible for as long as possible. Palliative care, when implemented well, can provide patients with a well-managed, coordinated end of life where distress and disruption is minimised. Current data suggests that 70% of terminally ill patients want to die at home. Only 15% manage to do this. ComfortCare's value proposition is to provide specialist nursing care to patients facing a terminal illness in their own home, where they are in a familiar environment with family and friends, their pets, and other home comforts. 3 care packages will be available for purchase and will include assessment of a patient's individual care needs and the provision of symptom management and psychosocial support. Palliation can occur at any stage of an illness where a terminal prognosis has been made. Given that people experience different illness trajectories and require different levels of support, ComfortCare will offer 3 levels of care packages based on level of care and duration. As the population ages, Australia will see a rise in the number of deaths occurring per year, with 160,000 in 2018 to 200,000 in 2030. Estimates suggest 50 to 90% of these people will benefit from palliative care. Adequate financial resources and higher education are key predictors of people dying at home. Based on this, ComfortCare has chosen to segment according to socioeconomic status and have obtained data that relates to death rates among the top 20% quintile for income in 3 major capital cities, Melbourne, Sydney and Brisbane. Clients impacted by Alzheimer's and various types of cancer will be targeted, as these conditions have a high tendency to require significant periods of palliative care. ComfortCare will aim to capture 12% of the market in the first year, with an annual growth scaling from 9% to 6% in the following 4 years.
The cash flow summary and NPV analysis on the financial model demonstrate that the business quickly establishes positive cash flows and has a positive NPV over 5 years. This is driven by an assumption that there will be a strong market penetration in the first year of operation due to market demand, and the ability to pass on the majority of expenses to the customer through the sales price structure and by keeping overhead expenses low. These 2 factors, together with a low startup cost, help drive the NPV to be positive. However, there are 2 key issues that are not as obvious from the analysis that present a risk to the financial viability of ComfortCare. Firstly, a high exposure to running out of operating cash due to its high operating costs and a low net margin of only 1%. And secondly, the Auckland expansion is NPV negative when assessed as an independent project. As such, it will present a financial burden on the rest of the business. The revenue for ComfortCare is primarily from the sale of care packages. Pricing is based on a 10% markup of the service provided, and payment must be made prior to the commencement of service delivery. The medium care package is forecast to generate over half of the revenue based on the predicted caseload of patients. Sales projections were based on health-related data for terminal illnesses in the relevant cities and an increasing market penetration. Revenue from the Sydney and Melbourne offices dominate due to their larger population of the targeted segment. Auckland is projected to generate only 3% of revenue, which is not likely to increase significantly, even with ambitious targets for market penetration and sales growth due to its relative smaller size.
ComfortCare has been structured to minimize the ratio of fixed costs versus variable costs in order to maintain customer affordability and attractiveness to potential donors. Fixed overheads relates to the establishment of charity and administration of corporate support services. Bottom-up estimation method has been used to identify costs, and a notional increase of 5% has been applied to cater for increased fixed costs. ComfortCare achieves a ratio of 90.44% of revenue being spent on services, which reflects an industry-best performance. Variable expenses include package costs that are directly associated with the delivery of services, including labor, equipment hire, consumables, and mobilization. ComfortCare hires contract labor for providing services, and it supports elasticity in order to meet surges in demand. Package cost does not include individual patient-specific needs such as prescribed pharmaceuticals. Analysis of ComfortCare's financial modeling shows that labor represents 73% of care-related direct costs and 71% of overall expenses. ComfortCare has focused on simple investment strategy to avoid costs associated with raising capital during the early stage of the organization, and it reflects in the low level of capital expenditure. The only exception is investments in the purchase of motor vehicles, which were purchased for the CEO and each of the 4 offices. ComfortCare is registered as a charity and is exempt from paying income tax. Impact of taxation has been included in the sensitivity analysis in case the tax-exempt status is not granted or delayed. Capital assets have been depreciated using a straight-line method over a 5-year period.
Sensitivity analyses are presented by percentage change in NPV. Green columns represent improved NPV, blues are scenarios where NPV deteriorates but remains positive, and red are negative NPVs. In terms of scenarios that improve net present value, the model was most sensitive to the difference between the rates of growth in revenue and expenses, the third and largest green column. By growing revenue faster than expenses at 5% and 2.5% respectively, an almost five-fold improvement in the initial modest $288,000 NPV is achieved. Smaller improvements were generated by testing alternative discount rates, shown by the other two columns. Predictably, lower discount rates improved the NPV, but notably a positive NPV was achieved at 30%, so changing the discount rate wasn't pivotal to the viability of the model. Arguably, the risk of a not-for-profit enterprise providing an essential health service is lower than some other business models and sectors, hence a lower discount rate may be justifiable. The first blue column tests the impact if tax-exempt status isn't granted. Net present value is reduced by almost half but remains positive. This is due to the low margins and profits of the business. However, this does indicate some insulation against future changes in government taxation policy. The first red column tests the negative impact of bad debts. The model was highly sensitive to this variable. A reduction in revenue of only 1% due to bad debts is sufficient to render the business unviable. The last two columns test the impact of different mortality rates among the medium and high care patients, which collectively represent around 75% of total revenue. NPV remains barely positive with a 5% mortality rate, reducing by 98%, and is negative using a 10% mortality rate. ComfortCare's cash flows and viability are exposed to multiple risks. Revenue is threatened by the risk of reduced sales and defaults on accounts receivable, and margins are threatened by increased staffing costs. The organisation also needs to prioritise maintaining an A+ Charity Watch rating. As a not-for-profit, it can't generate too much revenue without jeopardising its standing as a charity, thereby risking future fundraising activities. Mitigation strategies include increasing the markup from 10% up to 15%. If at the same time expense growth can be contained to 2.5% or less, a 4 to 5-fold improvement in NPV was projected in the sensitivity analyses. And obtaining government funding to subsidise care packages would reduce out-of-pocket costs for patients and reduce the portion of revenue exposed to the risk of default. Management KPIs would include careful management of accounts receivable and containment of expenses.
While the ComfortCare business plan presented a positive net present value, it is recommended that the charity not proceed with its current business model based on there being an insufficient level of operating capital. This could be rectified through increasing the level of markup by at least 5%, reducing significant corporate expenses through the consolidation of the office rental footprint or through reducing the fleet of vehicles. Also, care-related costs could be reduced through purchasing consumable goods in bulk. Revenue streams could be increased through increasing the level of donations, through additional advertising, or through employing alternate fundraising measures, establishing new donation channels, such as exploiting synergies in securing beneficiaries, or through securing government health care-related grants. ComfortCare should also reconsider the viability of the expansion into New Zealand, with further consideration of expanding into an overseas market with a larger population. From a methodology perspective, the group felt that strengths included that health-related datasets were consistent and readily available, the financial model was constructed in a manner which enabled the adjustment of growth and expense-related variables, and that the business model presented considerable opportunities for expansion through servicing patients with other illnesses, noting that baby boomers possess considerable wealth. Weaknesses included difficulties associated with obtaining detailed information related to patient funding, as this was based on clinical assessments. Mortality rates could also create customer churn, which may result in additional overhead-related costs being incurred. As palliative home care is an emerging market, the affordability of packages was difficult to assess, as was the degree of direct competition.